Hello guys, welcome to today's session. So this is Mac, the third of the fourth session for Mac. In the first session of Mac, we covered weighted average cost of capital. In the second section of Mac, we covered capital budgeting, and now we're going to cover the weighted average cost of capital. So capital budgeting and WACC generally counts for quite a bit of marks. I'm not sure how many marks is your test. You test 100 marks. And then, so capital budgeting and WACC will cover quite a bit of marks if it comes in. And I'm not sure how they test standard costing for you guys. It depends whether they make standard costing a big question or not. Sometimes standard costing just accounts about 15 marks or so. But if they set up a full question on standard costing, it can be a lot of marks. So this is session 3. We'll cover standard costing as you have requested. What you can do for the last session, which will be next week, you can tell me which topic you want to cover, or if there's a certain question paper you just want to cover. So you might just give me a guide as to what, because remember, we can't cover all the topics. The topics are too big to cover all of them. So that's why I selected the big ones. So you must select your last one, like you selected this one, standard costing. So the question would be, what is standard costing and why is standard costing important? And then last, we will go into how to go about handling a standard costing question, how to think through a standard costing question. So what is standard costing? Standard costing is generally just used, standard costing is used for planning and control. So it's used for planning and control. You'll generally find that manufacturing companies would use standard costing. So what they would do at the beginning of the year, virtually every company will set a budget. So they need to budget their expenses and so forth. The way they set their budget is by identifying what would be their revenue, what would be their sales. So they plan what they expect sales to be. As a result, they will have the necessary expenses. Now, when it comes to standard costing, we are mainly focused on the cost of a product, the cost of inventory. Now, remember, the cost of a product, the cost of inventory is made up of 3 things. It is made up of direct material, direct labor, and manufacturing overheads. Manufacturing overheads can include variable manufacturing overheads and fixed manufacturing overheads, depending upon which costing system you use. So at the beginning of the year, they come up, think about Coca-Cola. Coca-Cola would come up, they'll say, okay, we expect to make sales of a million bottles of 2 liters. Okay, let's just make it simple. They only sell 2-liter Cokes. So they expect to sell 1 million 2-liter Cokes. As a result of that, they will need to know that will help them determine how many 2-liter Cokes they need to produce in that financial year or in that period that they are budgeting for. By knowing how many units they expect to sell, that will help them determine how many units they need to produce. As a result, they will need to know, as a result of knowing how many units they need to produce, they will be able to determine how much materials they need, how much labor they require, and the overheads that will be incurred. So that is basically what we are trying to do. So we set the budget, that's the planning part. Now we come to the control part. The control part takes place where it's an after-the-fact situation. We have planned for a certain amount of units to produce. So when we actually start producing, now we will say, okay, based on our actual results, if we compare actual results to our budget, where are we? Okay, and that's how we'll be able to determine if there's any variances that are unfavorable, and that will help us to identify any issue so that we can fix the issue immediately. And that is the aspect of control. You're controlling costs so that you can pick up any major variances immediately. okay, or as soon as possible. So that is our aspect of what is the purpose of standard costing. Now remember, in the way we will compare actual direct material to standard direct, to budgeted direct material, and there may be a difference. Similarly, we will compare actual direct labor costs to the budgeted direct labor costs, and there may be a difference. And similarly, with manufacturing overheads, whether it's fixed and or variable, we'll have actual versus budget. But before we can do that analysis, there's one important thing that you have to make sure is correct. If this thing is not done, your whole standard costing analysis will be meaningless, will be useless. Okay, so to make standard costing meaningful, to make it useful, there's one thing that you need to do. Remember, we said you will plan at the beginning of the year, and let's say in the academic world for the full year. In the real world, they plan for a full year, but each week perhaps, or each month, or each quarter, they will update it. Okay, so they'll update it regularly. But in the academic world, we just assume we plan, or we do the budget once, which is at the beginning of the year for the entire year. So I just wanted to know, in the real world, that is not exactly how it works. They do budget at the beginning for the year, for the full year, but as the year progresses, they update their information. In the academic world, we ignore that updates. We just assume there's one budget set for the entire year with no subsequent updates. So let's say, as we said, what did we say? Coca-Cola is budgeting to sell 1 million units. As a result, let's just assume they need to produce also 1 million. Remember, your sales and what you produce will not necessarily be exactly the same. But just for explanation purposes, they budgeted 1 million sales, so they say we also need to produce 1 million. So the budget is based on 1 million units of production. If they actually produce 950,000 units, or if they actually produce 1.1 million units, by default, as a result of that difference of actual units versus budgeted units, there will be a difference. There will be a difference between budgeted information and actual information. As a result, we need to do one thing. In order for it to be meaningful, we need to adjust the budget to reflect actual units. So we're going to adjust the budget. They use the term flex the budget. So the budget is based on 1 million units, but because actual was 950, or let's say, let's go with 950, we need to adjust our budget to not represent 1 million units, but to represent 950,000 units. Now, the variance will be meaningful because you're comparing a budget based on 950,000 units with an actual of 950,000 units. So any variance now is meaningful because in theory they should have been the same, but it will most likely be different. But if you are comparing 1 million to 950, there will definitely be a variance. And that variance is useless because you're not comparing apples with apples. So therefore, before you do standard costing, or while you do standard costing, remember, you always have to flex the budget to represent actual units. So now that you flex the budget, we will now compare budgeted information with actual information. And if there is a difference, we now know this difference must be one of two things. There'll either be a difference between the actual price you paid versus the budgeted price, known as the standard price. Or the difference will be as a result of the actual quantity per unit versus the standard quantity per unit. So let's take another example to bring this aspect into so we can understand it. Let's assume your company produces furniture. Let's just make it simple. One type of furniture, which is tables. Let's say you produce student desks, okay, or study desks. you will know that one desk takes, let's say, 1 square meter of wood. So that is your standard. So based on your business model or your production model, one study table or one student desk uses 1 square meter of wood. That 1 square meter of wood per table, that is your standard quantity of input. At the beginning of the year, you budgeted 1 million, let's say a million tables. As a result, your standard direct material will be budgeted at 1 million square meters of wood. And let's say you, based on your current dealings with a supplier or whatever, you estimate that 1 square meter of wood will be 1 rand, $1, and as a result, the total direct material cost is $1 million. 1 million units budgeted for, multiplied by 1 square meter per unit, multiplied by $1 per square meter. So you get a total cost of $1 million. Now, when you compare to actual, remember what you need to do is that you must, when you're going to do the variance, you must make sure that the units used must be actual units. So, for example, in our budgeted, we have used 1 million units. So, to make it meaningful, you must change it 1 million units to 950,000 units. So now we have actual units, 950,000 units, but we're still keeping standard quantity per unit based on budget, and we are still keeping the standard price per square meter based on budget. Okay, so that is your standard cost. What we will now compare, we will compare the actual price per square meter that you paid, and you will actually compare the actual square meters of wood that you have used per table. So if we budgeted 1 square meter of wood per table, and if we actually used 1.1 square meter of woods per table, that means we have used too much compared to standard. If we have paid $1.5 per square meter, you would know we have overpaid because we budgeted to pay $1. So just keep in mind, when you're looking at standard costing, there are two variances, the price and the quantity. But what's very, very, very important, the total units needs to be based on actual. So even in your budgeted calculation, you must use actual number of units as opposed to budgeted, because that's what we call flexing the budget. Okay, so just keep that in mind. So if we recap, what is the purpose of standard costing? It is used for planning at the beginning of the year or the beginning of the period, and is used for control. As you produce, you will be comparing whether what you are producing is meeting your standard costs. If it's not, you will need to identify what is the problem and then try to fix it. That's the whole purpose of standard costing, so that you can ensure that you are meeting your necessary standards and you are not wasting. So that's the big part over here, to avoid any wastage. And then the how is basically, what are we comparing? We're comparing actual versus budget. We will get one number, but what do we know? That difference can be as a result of two things, a price difference or a price variance, as well as a quantity variance. So just keep that in mind. The most important thing in standard costing is to flex your budget. Your budget will be based on 1 million units, whatever you use at the beginning of the year. But when you do the actual variance, you need to flex the budget to represent the actual number of units. You are not changing the standard quantity of input. You are not changing the standard price. All you are flexing is the number of units. You have budgeted 1 million, but you only produced 950. So for your variance to be meaningful, for your variance to be useful, you need to change that 1 million units to represent actual units of 950. So just keep that in mind. There's two more things you must take note of when you do your question. And I'll bring it through as I go through the variances with you in Excel before we do a question. You must, as you read your question, you want to identify two more things. One, which costing system are you using? Are you using the absorption costing system, or are you using the direct costing system? The second thing you want to identify is how do you allocate overheads? Are you allocating overheads using units produced, or are you using an inputs method? An inputs method means you're allocating overheads based on either direct material or labor costs or machine hours. It's something going into the production process. If you knowing how you allocate overheads, whether it is something that comes out of the production process, units produced, or whether it's something that goes into the production process, such as labor costs, labor hours, machine hours, that has an impact on your variances. So I'll show you now as we go. I'm going to do the variances with you now, show you the formulas, and then I'll tell you where they would be, where those impacts would have. Because what you must know, in many cases, they're not going to, in some cases, they're not going to ask you for a specific variance. All they're going to say, dear student, please do the variances as far as possible. So if you don't know about these two issues, you're going to be looking for variances that may not even be there. Okay, so just be aware of that. So I'm going to switch over to Excel. While I switch over to Excel, do you have any questions that you'd like to ask me?
Hi, Faiz.
Yes.
Can you kindly go through again the two aspects that you have highlighted here? You said you have got two questions that you need to ask. Which costing system are you using, and how are you allocating overhead?
Yes, I'm going to do that. I'm going to explain that further as I do the variances now. It's only going to make sense when I do the variances. Okay, so I will explain that now. Okay.
Thank you.
Any other questions? I'll just open up Excel quickly. Okay, so you should see Excel. I just want to save this so that we don't have any problems. Okay, it's taking its own time, so let me just get on with it. Okay, so what did I say? So we're doing standard costing. Remember what I said, that the most important aspect that you must do when it comes to standard costing is to flex your budget. But you will see that when we come through, when we do a question. What I can tell you, they will give you straight zero if you don't flex the budget, even if everything else is fine. But because you're not flexing the budget, that's a fundamental concept within standard costing. So just make sure you're always using actual units. Okay. And then what you should also know is that you will, how can I say now? You might just be aware of the two things, the costing system, as well as the way you allocate overheads. Now, typically, what's going to happen, let's say you're a management accountant or a financial accountant, and you are responsible to compare, and let's say you're working for a manufacturing company. In many cases, a manufacturing company is going to set their budget when they do the income statement. What they're going to do is they're going to base their income statement using standard information. Okay, so they're going to work out the income statement. Now remember, income statement is sales, less cost of sales, less other expenses, and it gives you profit. Okay, so you can try to picture an income statement in your mind. Sales, less cost of sales gives you gross profit, whatever it is, and then other income, other expenses give you profit for the year, or give you profit before tax. So in the real world, a company that is using standard costing, the income statement is based on standard costs. Then they're going to get a profit, but that profit is based on standard costs. Okay, so what would happen? They'll have, let's just say they have sales, cost of sales, and this will give them gross profit. Then they'll have other expenses, and then they'll have profit before tax. Now, this profit before tax over here, if they're using a standard costing system, could be based on standard costing. So that this profit before tax is a standard cost profit before tax. But then they're going to compare it to the actual information. Then they're going to say, okay, I'm just going to make up numbers for now. It's 100,000 Rand profit before tax based on standard costing is 100,000 Rand. But when they compare it to the actual information, profit before tax based on actual information, let's say, is 90,000 Rand. What do you notice? What do you notice? That the profit before tax based on standard information is 100,000 Rand, but the profit before tax based on actual information is 90,000 Rand. So what do we see? There is a variance. So typically, if they give you a full standard costing question, there's only if it's a full standard costing question, they're going to say there's a loss of 10,000 Rand. There's a variance of 10,000 Rand. They're going to say, dear student, this is only if it's a full standard costing question. Please reconcile that difference. So what you're going to do, in order to reconcile that difference, we're going to use the variance, the standard costing variances. So it's going to be, so remember, ultimately your variance is as follows. Budget, actual. And that will give us a variance. Okay, so that is basically what's happening. Budget versus actual. Budgeted profit before tax versus actual profit before tax gives us a variance. But now they say, now remember that is made up of various numbers. Now they say reconcile that variance. It's typically going to be reconciled as follows. Sales. Now remember, cost of sales is made up of direct material, direct labor, variable manufacturing overheads, and fixed manufacturing overheads. Remember, if you're using the direct costing system, it will only be that. If you're using the absorption costing system, it will include fixed manufacturing overheads. So just take note of that. So what would happen? There'll be a variance between budgeted sales, actual sales, which just gives us a variance. There'll be the variance will be budgeted versus actual, budgeted versus actual, budgeted versus actual, budgeted versus actual. See the big picture. We're going to come to the details now. Picture yourself. You are a management accountant. You are doing an income statement using standard information. You get to $100,000. When you use actual information, it is $90,000. There's a difference. So you need to explain that difference. The way accountants explain a difference, the way accountants explain movements is through a reconciliation. So how are we going to reconcile? By looking at the details. These are the details, and we're going to compare budget versus actual, and this variance of all of those information will add up to the $10,000. But what do we know? When it comes to standard costing, that variance can be broken up into two parts. This variance over here can be broken up into two parts. For each line item, this variance can be broken up into two parts. It can be broken up into a quantity variance, and it can be broken up into a price variance. So what would happen, that variance is no longer going to be one variance. It will be a quantity variance and it will be a price variance. In order to do that, we're going to have another line item. We will have the flexed information over here. Your actual is as follows. Actual quantity multiplied by actual price. Your budget is based on we'll come to that one. I was going to say standpoint in time. Your budget is going to be, these are the flexed. This one is going to be actual quantity multiplied by, this one is going to be actual quantity multiplied by standard quantity of input. So take note over here. I want to take note over here. This over here is flexing your budget. In the actual budget, you're not going to be using actual quantity. You are using budgeted quantity. If you leave it at budgeted quantity, the whole variance will be meaningless. So to flex the budget, we change budgeted quantity to represent actual quantity. So what are we doing? We're saying the actual units produced multiplied by, so the actual, let's say we made 950,000 tables, 950,000 tables multiplied by the standard quantity of input. Each table, based on standard information, should use 1 square meter of wood. So this is saying 1 square meter of wood, standard quantity, multiplied by the actual number of tables. So that gives you the flexed budget in terms of quantity used. What we're going to do here, we're going to multiply it by our standard price. So I just want to show you something over here quickly. This is flexing your budget. Please, you need to get this right. How do I make this right now? So this is extremely important. That is flexing your budget. Do you have any questions on that? Please ask me if you have any questions on this aspect over here. Does everyone get that? Try to picture something that you can understand. Like I just typically use tables because everybody know what a table look like. Everybody understand that you can produce a million tables. But the important aspect is when you look at your budget, you must still use the standard quantity of input. Standard quantity of input means how much material are you using for one unit. So for each table, how much wood are you using? The standard is, it is 1 square meter. So that SQI represents 1 square meter of wood per table. But now we're saying we're going to multiply it by the actual number of tables we made, 950,000 tables. So that tells us, given the 950,000 tables we actually made, how much wood should we have used? We should have used 950,000 square meters of wood. Okay, so just keep that in mind, multiplied by our standard price. I'm starting to think of something over here. Standard price, standard price. Okay. And then here is going to be actual quantity times standard price. Okay, so just be aware of that. So what you should be able to think through when you do standard quantity, when you do standard costing, is that when you want to reconcile, that variance, always remember you need to reconcile the following. You need to reconcile sales, and you need to reconcile the cost of a product. What is the cost of a product? Direct material, direct labor, variable manufacturing overheads, fixed manufacturing overheads. But then you must remind yourself that each of these line items can have at least 2 variances. Okay, so for sales, we will have we can have a volume variance, and we can have a price variance or a rate variance. I just want you to know that they use different terminology, okay? So in general, it's always going to be a quantity and a price. But for some quantity, they refer to volume or they refer to efficiency. For price, they may use the word rate. So just be aware of that. Okay, but in general, big picture view, you have one variance is broken up into 2, a quantity and a price. Then we have that's for sales. Similarly, for direct material, we'll have 2 variances. What would be the 2 variances? Quantity variance. So for example, for sales, they don't use the word quantity, they use the word volume. Quantity variance, but for direct material, they use the word quantity. And then for direct material, we'll also have a price variance. For direct labor, once again, we'll have another variance for direct labor. Once again, we'll have a quantity and a price. but the terminology they use for direct labor for quantity, they don't use the word quantity, they use the word efficiency variance. But this refers to the quantity variance, okay? And for direct, and then for the price variance, they don't use the word price, they use the word rate variance. For variable manufacturing overheads as well. For variable manufacturing overheads, what do? Also have a quantity and a price, but they don't use the word quantity, they use the word efficiency. They don't use the word price, they use the word rate. Or not actually rate, they use the word spend. They use the word spend variance. Okay, so what I want you to know that there's always a quantity and a price variance. But in some aspects, they don't use the word quantity, they use the word efficiency. They don't use the word price, they use the word rate or spend. So just be aware of that. Okay. So what I want you to see, put yourself as if you are a management accountant. At the end of the month or the end of the year, you draw an income statement. Your income statement is you have two income statements. Okay, so your income statement you get a profit line item, and that profit line item is based on standard information. Then you also have a profit line item that is based on actual information. So the profit line item based on standard information turns up to be $100,000. The profit information the profit number based on actual information turns out to be $90,000. As a result, there's a variance. You as a management accountant, you need to understand that variance because you are the management accountant. You must be able to explain this variance. And the way accountants explain a variance is by doing a reconciliation. So we're going to reconcile that difference. We know what goes into the profit numbers. It is sales less costs. So for our purposes, we're going to identify all the sale items and we're going to identify all the cost items. For our purposes, it's generally going to just be one sales or two sales by one line item called sales. And then the main cost is going to be the cost of a product, which is direct material, direct labor, variable manufacturing overheads, and fixed manufacturing overheads. It can include other non-cost projects like variable non-manufacturing costs, fixed non-manufacturing costs, but they hardly bring that in because the principle will be the same, okay? So it'll end up being sales and the cost of a product, which is direct material, direct labor, and manufacturing overheads. But remember, manufacturing overhead is split between fixed and variable. Then you're like, okay, you have the variance, which is $10,000. You know the variance can be made up of four things: sales, direct material, direct labor, manufacturing overheads, but manufacturing overheads can be split up further. Then you're like, okay, for each line item, there's at least two variances, a price variance and a quantity variance. Okay, so now you know there's a price variance and then there is a quantity variance. So you need to split each one between its price and its quantity variance. So let's see how this one would look. So for quantity variance, what would happen, it is going to equal to standard price multiplied by standard quantity of input multiplied by actual quantity. Okay, so I just want to show you standard quantity of input is going to be multiplied by actual quantity. So please be aware over here. We're using standard price, okay? We're using standard price. Then we're comparing standard quantity versus actual quantity. So you produced 950,000 tables, okay? This is saying you produced 950,000 tables. So this is saying based on 950,000 tables, you should have used 950,000 square meters of wood. But you're saying actual quantity, 950, sorry, I don't use actual quantity. I should be saying actual units. Okay, so there's no confusion. This should be actual units. Okay, now it makes more sense. So this is saying over here, actual units, 950,000 tables multiplied by the standard quantity of input. What is the standard quantity for each table? 1 square meter of wood. So therefore, 1 square meter of wood times 950,000 tables should be 950,000 square meters of wood for all the tables. You compare it to actual. Actual could be, let's say, 940,000 or 960,000. So there you can see there is a difference. But what is now correct is that this quantity is based on 950,000 units, and the standard quantity is also based on 950,000 units. So now we're comparing apples with apples. So any variance is solely as a result of how much wood you have used per table. That is what we want. For the price variance, what would happen is we will use actual quantity and we will compare it to standard price versus actual price. So have a look. When we come to standard quantity, the price is based on standard price. When we compare the price variance, the quantity is the common denominator, is the common number, and it's based on actual quantity. Because remember, when you're going to the store, you're actually buying certain number of square meters. So you must compare based on the actual quantity you acquired, you purchased. So that's very, very important. Okay. Similarly over here with direct efficiency, with direct labor, the efficiency variance. This refers to the quantity variance. So remember, when you're working with the quantity variance, the price is the common number. So we keep the price constant. The price is always based on standard. So this will be standard price. But remember, we don't use the word price when it comes to labor. We use the term rate, standard rate. And now we compare it to standard quantity versus actual quantity. So standard quantity compared to actual quantity. But now remember, we don't use the word quantity for, we don't use the word quantity when it comes to labor. We use the word actual, we use the word hours. So we're comparing standard hours to actual hours. The way we calculate, once again, when it comes to the quantity variance, it is the standard quantity of input. How much time does each table take? That is your standard quantity of input. How much labor hours should each table take? Multiplied by the actual units produced. So we're keeping it at 950. So the actual units is your 950,000 units. So please be aware of that. So your standard quantity of input is how many hours should each table take. So the standard quantity of input, how much time should each table take? Let's just make it for simple purposes, 1 hour. Actual units produce 950,000 tables. So therefore, in total, they should be taking 950,000 hours if they're matching standards. Now we compare to how much hours they actually took. Was it 950? Was it 945? Was it 948? Okay, so that is basically it. Once again, with the rate variance, actual hours is the constant number. We're going to compare it to standard rate, what the rate we budgeted to pay the labor for versus the actual rate we are paying. So remember, like, I don't know how it is in Zimbabwe, but in South Africa, there's a lot of strikes. So at the beginning of the year, the company may have budgeted to pay labor 40 Rand per hour. Strikes take place, it ends up being 42 Rand per hour. Okay, so they budgeted the standard rate of 40 Rand per hour, ended up being 42 Rand per hour. Okay, now we compare the actual hours, because remember, we can't pay labor based on budgeted hours. We pay them based on the actual hours worked. So saying that's why we use actual hours. Similarly over here, when we pay the supplier doesn't care how much quantity we budgeted for. They need to be paid based on the actual quantity you purchased. That is why we use actual quantity. Similarly over here, labor doesn't care how much hours you budgeted. You must pay them based on how many hours they actually worked. So try to make intuitive sense of the variables that we are using. Similarly over here, I see there's a message, I'll check now. Similarly over here, with the efficiency variance, it's going to be the same. Standard rate multiplied by, that will be exactly the same. Now here is where that thing comes in. You will only have this, you will only have the efficiency variance if the basis of allocation is the basis of allocating overheads is an input. So example, it is labor hours, labor costs, machine hours, etc. Okay, if it is units produced, then you will not have, if overhead is allocated based on units produced, you will not have an efficiency variance. Don't look for it. You will not be able to calculate it. For the spend variance, it will simply be, for the spend variance, simply be budget minus actual. So to just take note of that. Let me see, there's a few questions over here. Is it AR or AH? Could I just quickly speak? Maybe it'll be more easy to understand. Oh, you mean yeah, sorry, you mean yeah. Yeah, sorry, thank you. Yes. Actual rate. Right. Yes, actual rate, correct. Thank you for picking that up. So then here also, that's right. Okay, just be aware, efficiency variance, you will only have an efficiency variance for variable manufacturing overheads if and only if your basis of allocation for allocating overheads is an input, labor hours, labor costs, machine hours, direct material costs. If it's an output, like units produced, you won't have an efficiency variance. So why this is important, like I said, sometimes they will tell you, dear student, do all variances as far as possible, in as detail as possible. So when I was a student, I always used to look for this variance. Only long after I figured out, when I actually learned that you will only have an efficiency variance if base of allocation is an input. Okay, so pick that up when you read the scenario. So then automatically you must know if they ask you for a variable overhead, If it's an input, you can have both variances. If it's an output, you will only have a spend variance. Spend variance is simply budget versus actual, but basically you can calculate it like this. Okay, so we calculated the same. Actual hours multiplied by standard rate minus actual rate. So please make sure you pick that up. So if you allocate overheads using an output, you will only have spend variance. If it's input, you will have both spend and efficiency. Very, very, very important. Okay. Fixed manufacturing overheads is slightly different. Okay, because remember that the whole point of fixed manufacturing overheads, it does not change with output. Okay, fixed manufacturing overheads by its very nature is fixed. It does not change relative to units produced, relative to outputs, and so forth. Okay, so as a result, it will be different to the other variances. So you can have you will have two variances. You can have two variances, a volume variance and a also a spend variance. Okay, we can, I call it a spend variance. Oh, sorry, did I just do? Okay, so a volume variance, you will only have a volume variance if you're using absorption costing system. If you're not using an absorption costing system, you will not have a volume variance. If you're using the direct costing system, you can't have a volume variance. If you're using an absorption costing system, then you will have a volume variance. Volume variance is fixed overheads applied minus budget. Spend variance is budget minus actual. So this one is easy. Okay, they'll give you the budgeted costs for fixed manufacturing overheads. They will give you the actual, just minus the 2. Fixed overheads applied is a little bit more detailed. You'll have to be able to calculate fixed overheads, but you'll have budget. But remember, you can only have fixed overheads applied if you have, and if you're using the absorption costing system. So you'll only have volume variance if you're using the absorption costing system. If you're using the direct costing system, there's no volume variance. So as you can see, this plays a crucial role. Okay, plays a crucial role. So please be aware of that. Under sales, under sales, volume, because we're trying to work out volume, we will keep something standard, which is the standard rate. Okay, so the price remains the same, and we will compare actual quantity sold minus budgeted quantity sold. For price, what do? We keep actual quantity. Okay, so for price, so this is where it becomes a little bit important to take note. This would either be contribution margin or gross profit, or we just use the word or gross profit multiplied by actual selling price minus, wait, let me just see what I'm doing here, price variance. Oh, sorry, I got that wrong. Just change this out. So for price variance, it will be actual quantity sold multiplied by standard or actual selling price minus standard selling price. Okay, so that's easy. Actual quantity sold comparing to what you actually sold the thing for versus what you budgeted to sell the thing for in terms of price. The volume variance, we are still using actual quantity sold minus budgeted quantity sold. But what we're going to multiply by, is contribution margin or gross profit. Okay, so once again, if you are using, so you use CM if direct costing system, use gross profit if absorption costing system. So as you can see, when you read the scenario, there's basically three things you need to identify. Number one, whether you must flex the budget. You will flex the budget if budgeted production is different from actual production. You will flex the budget if budgeted production is different from actual production. That's highly probable. Okay, so that's most likely going to be. So that's the first thing. You must pick up as you read. The other two things you need to pick up: which costing system is the company using? Are they using the absorption costing system? Are they using the direct costing system? Because as you can see, the costing system impacts your sales, impacts fixed manufacturing overheads. The third thing you need to pick up is, how do they allocate overheads? Are they allocating overheads using an input, or are they allocating overheads using an output? Examples of input: direct labor costs, direct labor hours, machine hours, direct material costs. Anything that is an input into the production process is an input. An output is what comes out, the units produced. You can see the basis for allocating overheads impacts variable manufacturing overheads. This impacts another aspect. We'll come to it now. Okay, so those are your typical variances. But now there are some further variances. So we call this, like, if I can call it, further or advanced variances. So for quantity variance, the quantity variance may be broken down further. Okay, so for direct material and for direct labor, the quantity variance can be broken down further. Between a mix and a yield. Okay, so your quantity variance can be broken down further into a mix and a yield. Same thing over here by rate. Yes.
Sorry, Fires.
Yes.
All right. Maybe the team can confirm.
I can't hear what you're saying.
For this, I'm saying yield and mix variance.
Yeah.
We are not covering them this semester. I just need to, if the team can confirm. Hello, can you hear me?
Guys, let's just see the saying in the group. Yeah, so you do, so it is there. So mix and yield is a part of your syllabus. I'd assume it is, if you see it there, one.
Oh, they are saying, I think somebody commented that we
are we're not covering mix and yield. Okay, perfect. So I can leave it out.
Oh, yes. Thank you, Faiz.
Okay. Then just check this one also for me. Volume variance can be split further. Do you do that? A volume variance can be split into a capacity and efficiency. Just tell me if you've seen this. We're covering that.
Yeah, that one we are.
This one you are covering, okay? So capacity and so the volume variance can be broken down into capacity and efficiency. It can only be broken down for, firstly, you can only have a volume variance if you're using the absorption costing system. So if you're using direct costing system, there can't be a volume variance. But if you are using the if you are using absorption costing system, there will be a volume variance. The next question is, can you break down the volume variance further? So you will only have it if you are using if you will only be able to break it down into a capacity and a volume if you are using the what now? What is this now? If you are using if your basis of overheads is an input. So if your basis of overheads is an input, you can break down the volume variance further into capacity and efficiency. If you're not using if your base of allocation is units produced and output, you cannot break it further down. So what I want you to do is think about this and how can I say? So think about it so that when you do when you read a question, what I want you to get to, when you read a question without looking at the details of the question, you must already know, okay, I'm going to have this variance, that variance, this variance. Okay, and one of the important stuff is basically almost all those variances will apply. But what do you notice? You will use CM or GP depending upon which costing system. You can only have an efficiency variance for variable manufacturing overheads if you are using an allocation basis that is an input. You can only have a volume variance for fixed manufacturing overheads if you are using the absorption costing system. The volume variance can only be broken down further if you are using, if your base of allocation is an input. If it's an output, there's no further breakdown. So those are the stuff you need to be aware of. Okay, so just be aware of that. So when you do a variance, I just went the long way because if they ask you for the full question, this is how the full question will be. In many cases, they're just going to say, dear student, please determine the direct material rate variance. So then you just do that one. But if they ask you, dear student, please, this is the full question, dear student, please reconcile budgeted profit or standard profit to actual profit, then this is what you're going to have to do. Okay, so just be aware of that. The way I like to do it is exactly out easier. Show budgeted profit, show actual profit. You don't have to do all of this. They'll give you budgeted profit most likely. So you show budgeted profit, you show actual profit, and then you get your variance. Then I say reconcile as follows, and then the answer needs to come to $10,000, and then you'll net off to 0. Okay, so just be aware of that. So that is what I want to cover here. We will do a question. Let me just quickly check the question. We may have to do the question later because I have another class now. I'm just going to check the question. I'll give you just another hour. We can do the question later today. Okay, I'm just going to check quickly the question. Where is it that you sent me now? You sent it in the chat, right? So,
Yes, it's in the chat.
What am I looking for? Oh, here we go. But where's standard costing in this question? There's you sent me, what is this, city roads? Where's the standard? I don't see standard costing in there. I can't use UCT. It's just too risky. They're going, it's copyright. So I don't want to use. What I'm going to do is, so we won't be able to cover it because I have a class now. Later we do. Are you available later today to do the question on standard costing? Then I'm going to source a question. I'm either going to look from UNISA or I'm going to look from Psycha. So at least Psycha is open. So then it's on the website. Anybody can download it. So then we know we are okay with that. Will you be okay doing a standard costing from Psycha? If I can find one, otherwise I'll just take one from UNISA. And are you available later today? Like, let's say, okay, because we're going to run, it's going to be too long, standard costing question. So what I want you to do is just try to picture this, the format I've given you now. Just try to picture the format I've given you. And so try to picture this format. Understand that in a typical standard costing, when a company uses standard costing, what's typically going to be the profit number is going to be based on standard costs. Okay, but then we need to, but then they also compare to the actual information, and then there's going to be a difference, and then we have to reconcile it. So the way we reconcile it is by identifying what goes through the income statement, which is sales, direct material, direct labor, variable manufactured overheads, and so forth, and then the variances that results as a result of that. And the variance is between quantity and price. The three important things you need to identify is flexing, and then identifying whether we're using absorption or direct, and what's the implication of that, and the basis of allocating overheads, whether it's an input or an output, and what's the implication of that. Okay, so I'm going to stop here, and then later today I'll just confirm the time a bit, probably be around 5, 6, but we won't do an hour, and then we'll do an hour max, maybe shorter depending on the question that I get, and then we will cover that question. Is that fine with you guys? Okay. So I'm going to send you this in the group now. I'm going to send you this Excel in the group now, so you can just see the formulas and so forth. And then I'm probably not going to be able to get a question that all the variances in. Like, it's difficult to find a question like that unless there was one specifically done for the module. So I'll try to find one that has as many variances as possible. Okay. I definitely have a third year question. I just need to find it from UNISA. Okay. So thank you guys. I'm going to stop the thing now, but before we stop, do you have any questions?
Not me, Faiz. Thank you.
Okay. Okay, cool. So thank you very much, guys. Bye-bye.
Bye.
Sure. It will record now. Okay. Okay, bye-bye.